Hello and welcome back, Focus Learners. I am so thrilled to have you here for today's explainer. We're going to dive right in and demystify a concept that honestly puzzles novice and seasoned investors alike, and that's index valuations. Specifically, we're going to look at the broader Indian market through the lens of the Nifty 50. And then we're going to zoom way in to figure out exactly why the market is willing to price certain cash cow companies like Eicher Motors so very differently from the rest of the pack. Let's get right into it. Think about it like this. If the market average is priced at, say, $1, why on earth are rational, data-driven investors happily paying $2 for certain outlier stocks? I mean, is it just irrational exuberance, or is there an actual mathematical justification for it? Well, we're going to unpack the anatomy of a premium valuation today and show you exactly why high-performing outliers can command top dollar compared to the broader market. So here's our quick roadmap for today. We'll kick things off by decoding the Nifty 50, then move into Nifty valuation trends explained. After that, we'll look at the Eicher Motors exception, spend some time justifying a premium valuation, and finally wrap up with the market outlook and future targets. All right, starting off with Section 1, decoding the Nifty 50. Now, you probably already know that the Nifty 50 isn't just some random basket of stocks. Launched back in 1996, it is the ultimate barometer of India's blue-chip companies. It represents the 50 largest, most liquid companies listed on the National Stock Exchange. And what makes it the perfect macro anchor for our analysis today is that it captures roughly 66% of the exchange's float-adjusted market capitalization spread across 13 different sectors. So when we talk about the market average, we're talking about the Nifty 50. It really is the truest representation of the Indian corporate economy. It sets the standard. Moving right along to Section 2, Nifty Valuation Trends Explained. To make sense of premium stock prices, we all need to be on the exact same page with our core metric, which is the price-to-earnings, or PE ratio. As a quick refresher, it measures the price investors are willing to pay for every single rupee of earnings generated by a company, or an entire index. If the PE is 15, you're essentially paying 15 rupees for every 1 rupee of corporate profit. It's really the ultimate gauge of market sentiment. So, here is the absolutely crucial point. Over the last 10 years, the historical anchor for the Nifty 50 has settled comfortably at an average PE of 20.7x. This right here is our baseline. Historically speaking, investors are willing to pay 20.7 times the earnings of these top 50 blue-chip companies. Anything significantly below this might signal undervaluation, and anything significantly above it might suggest things are overvalued. I want you to keep this 20.7x multiple firmly in your mind as we move forward. Which brings us to Section 3, the Eicher Motors exception. Now, what's really interesting here is the sheer contrast. It's kind of wild. On the left, we've got our trusted market anchor historically trading at that 20.7x multiple. But on the right, look at Eicher Motors, a prominent Nifty 50 constituent itself, currently trading at a massive PE of 36.51x. That's nearly double the historical market average. A novice investor might look at this and immediately yell overvalued. But as focused learners, we know the market is usually pretty efficient. If Eicher commands this massive premium, there's got to be a compelling reason in their fundamentals, right? Let's find out in Section 4, justifying a premium valuation. Check out this number, 24.1%. This is Eicher Motors' return on equity, or ROE. Basically, ROE measures how efficiently a company's management uses shareholder equity to generate profits. For a heavy manufacturing and automotive company to consistently pull in a 24.1% return on equity, that is absolutely stellar. It proves incredible management efficiency. See, investors aren't just paying for current profits, they're happily paying a premium for a management team that continually proves it knows exactly how to compound shareholder wealth. But wait, it actually gets even better, 29.81%. This is Eicher's return on capital employed, or ROCE. Now, this metric looks at the efficiency of how all capital, including debt, is utilized. Pulling a nearly 30% ROCE in the incredibly capital-intensive auto sector, that is what makes Eicher Motors a true cash cow. They've built a business model that efficiently turns raw capital into cold, hard cash at a rate far superior to the broader market. When a company acts as an elite compounder of capital like this, the market happily assigns it a premium PE multiple. And this breakdown brilliantly illustrates the whole shebang. Look at how Eicher stacks up against heavyweight peers in the auto sector. Maruti Suzuki trades at a PE of 28.33 with an ROCE of 21.7%. Tata Motors sits a lot closer to the market average, with a PE of 22.07 and an ROCE around 20%, but Eicher, it literally leaves them in the dust with its nearly 30% ROCE. This fundamental dominance also explains why Eicher commands a price-to-book value of 8.93, compared to Maruthi's 4.24 and Tata's 1.20. The market simply trusts Eicher's cash-generating engine more, so it prices it higher. It's not necessarily overvalued, you're just paying a premium price for a premium asset. Let's zoom back out for our final section, Section 5, Market Outlook and Future Targets. To really understand the future, we need to look at projections. Here are Kotak Institutional Equities targets for the end of calendar year 2026. Notice how these actionable targets revolve perfectly around our baseline. Kotak expects the Nifty 50's earnings per share to grow to 1,456 rupees by fiscal year 2028. For their base case, they multiply that earnings estimate by 20.0x PE, which, remember, is actually slightly conservative compared to our 10-year historical average of 20.7x, and that gives us a target of 29,120. For their bull case, they assign a premium multiple of 22.0x, giving a target of 32,032. And in a bear market scenario, they apply a discount at an 18.0x multiple, for a target of 26,008. Which leaves us with this final, rather provocative thought. We've seen that a premium price tag on a stock like Eicher Motors is totally justified by its incredible cash-generating fundamentals today. But here is what I want you to think about as you review your own portfolios. Does that premium price tag guarantee premium returns indefinitely? Or is it kind of like a law of market physics that even the greatest cash cows must eventually see their growth slow down and their valuations pull back to that 20.7x market average? I encourage you to use the frameworks we discussed today to analyze your own holdings and decide for yourself. Thank you so much for joining me on this explainer. Keep learning, and I'll see you in the next one.